Okay, so in chapter 4, we're introducing the concept of accounting for a merchandising operation. So you may have noticed most of the examples that we've worked to date have been for service companies. When we record revenue, it's typically service revenue. So we are introducing the concept of a merchandiser. So the difference between a merchandiser and a service company. Service organizations sell time or provide a service. You know, like the paralegal was one of the companies, or a company that installed siding. Those are examples of service organizations. Merchandisers are retailers, wholesalers, the Walmarts of the world, and their revenues are typically sales revenue. All right. So on this slide here, we see that the general process to net income for a service company, which we know we've done this, revenues less expenses gives you net income. All right. So we've done that several times. A merchandiser, however, has some additional steps. But let's talk about what a merchandiser is. All right. Merchandising companies fall into two broad categories. The first being a retailer. All right. And a retailer is the company who sells goods to end consumers. So Walmarts and Targets of the world. Amazon would also be in this category. Those are retailers. Wholesalers, sometimes called distributors, their business model is they purchase items in bulk from the manufacturer and sell to a retailer. All right. Many large retailers kind of skip the middleman, so to speak, and buy directly from the manufacturer. But wholesalers definitely have a place in the market because they have relationships with manufacturers, and oftentimes they'll handle the logistics of delivery to the retailer. All right. So in this chapter, the accounting we're going to do will work for both wholesalers and retailers. All right. So here we have basically the income statement for a merchandiser, and we can see it's a bit more complicated. It starts with net sales, which is sales revenue less returns and allowances. And returns are what it sounds like. Consumers, customers bringing back goods previously purchased. Allowances are typically discounts. We'll get into that, but discounts for merchandise that didn't meet expectation. And of course, the difference is that with allowances, the purchaser keeps the goods and just takes them for a lesser price. So net income, or I'm sorry, net sales, which is gross sales less returns and allowances, gives you cost of goods sold. All right. Cost of goods sold is well, technically it's an expense, but for merchandisers, it's typically the single biggest expense that they'll have, right? Because it's the cost of everything that they sell. If Walmart buys a jar of peanut butter from a manufacturer we'll call Jif, and they pay 50 cents for it, and then they sell it for 75 cents, well, that sale generates 75 cents worth of revenue, and cost of goods sold for that sale would be 50 cents. Right? So that's how cost of goods sold works. It is an expense. The difference between those two is gross profit. So you want to think of gross profit as the difference between the cost of the sales, or let me say it this way, the difference between the revenue of the sales and the cost to make that sale. All right. Minus, and we'll sometimes call these operational expenses. Right. These are the things that keep the lights on, the store clean, paying the staff. It gives you net income. All right. And here we have an example of a service company, revenues, expenses, net income, merchandiser company, net sales, cost of goods sold, giving you gross profit. And you want to think of gross profit as an amount that's left over after you've covered your cost to make the sale, to cover operational expenses, and to provide for net income. All right. Okay. So in this chapter, we're going to detail inventory systems. And an inventory system is a process by which we distribute the cost of inventory between beginning inventory plus purchases of inventory made during the period. And it says net because merchandisers can return purchases as well. So this will be purchases less returns. Gives you merchandise available for sale. All right. And so that number we need to split between ending inventory, which is what's on hand and unsold at the end of the period, and cost of goods sold. All right. So obviously cost of goods sold is the expense number from the previous slide, detailing how much it costs to make those sales. Okay, so let's talk about inventory systems. There are two types. We're going to focus our efforts on the perpetual inventory system. So to that end, let me talk about a periodic inventory system and what that is. So the idea with a periodic inventory system is you update inventory records, i.e. you split between ending inventory and cost of goods sold at the end of the accounting period. And typically that corresponds with a physical count of inventory. So not unlike what we did with adjusting entries, you go and physically count the inventory that's on the shelves in your retail establishment or in the warehouse, whatever it may be. And you would subtract that from cost of merchandise available for sale or cost of goods available for sale, right? Which is, of course, what was in the warehouse or the store at the beginning of the period plus purchases. So when you count what's on hand at the end of the period, you subtract, and that gives you your sales, your cost of goods sold during the period. And that's how a periodic inventory system works. Now, it is seldom used. Very few companies still use this. It's thought to be an older approach. So modern inventory systems are perpetual inventory systems. All right. So perpetual inventory systems are, so if you're at the retail point of sale, so you're at the register and there's a scanner, that scanner is tied to a perpetual inventory system. And so as you check out, if it's self-checkout or if there's a cashier that scans your items, as those items are scanned, that system does a couple of things. For starters, it updates the inventory count in real time. So if you're you're at Walmart and there were 10 jars of peanut butter on the shelf and you purchase one, when you scan that, immediately typically, or at least at the end of the day when the system updates, the records would be updated to show that there are now 9 jars of peanut butter in inventory. Also, it would record the cost of that sale. So it would move the cost of that 1 jar from an inventory asset to cost of goods sold expense, right? Because the company now no longer owns that jar of peanut butter. It's been sold, right? So at year end, you just run a report in your perpetual inventory system that gives you cost of goods sold, right? And modern retailers, merchandisers use this because it allows for better inventory control, better, more concise ordering of goods closest to the time that they would be available or be needed for sale, I should say. So that's a perpetual inventory system, and that's what we are going to learn about in this chapter and the next. Okay, so this slide does a good job of detailing, and it looks like previous slide we had, and it is, but it just kind of details cost flow in the accounting cycle. All right, so beginning inventory, well, that's the stuff that company has available for sale as of the first day of the accounting period. All right, during the period, purchases made from a supplier less returns is net purchases, and that gives us merchandise or goods available for sale. All right, beginning inventory plus net purchases gives us merchandise available for sale. During the period, presumably some goods are going to be sold, hopefully most of the goods. Those sold give you cost of goods sold expense, and that goes to the income statement. All right. Unsold inventory is an inventory asset. So that's on the balance sheet, and it rolls forward. So ending inventory in one period rolls to the next period and is beginning inventory for the next period. All right, and the process repeats itself.